So here we are again. Paolo, Mr. Mustache, Elon. So today we're going to speak about stock liquidity and why is it important and why did we create this feature for Quick Capital? Why are we so interested to understand the liquidity, the level 2, the bid, the ask? So I think this is the kind of stuff we are going to cover. So Elon, do you want to start?
Yeah, thank you for that, Ari. We appreciate it. You guys looking great as always. So liquidity wise, why did we go ahead and put together kind of a volume tracker to really understand what the company's liquidity is like? And when I say liquidity, we're talking about trading liquidity, right? We're talking about how many shares, and we're talking about the dollar amount of shares. It was really created to know if we were to give a company capital, right? If we were to give a company money today in a debt structure, which is typically what we look at and what we've looked at previously, and that's our business, right? So we would try to look at historical data in order to estimate what the future data would be, right? How did the stock trade in the last week, in the last 2 weeks, in the last 30 days, in the last 60 days, in the last 90 days? How much dollar volume did it trade? And by using those metrics, we kind of try to estimate what we think it's going to continue to trade. And why do we do that? Is because when we give a company a debt, and when they don't repay the debt, we need to convert the debt into equity, right? And when we convert the debt into equity, we need to be able to liquidate that equity into the marketplace. So a rule of thumb that we created was, hey, we do not want to be more than 10% of the daily volume of a company's liquidity. We don't want to be more than 10% of the trading volume of that day, of that month, maybe 15, maybe 20, depending on the company, depending on the situation. But that was really kind of like the rule of thumb. So if we knew that a company traded, $100,000 in the last 30 days, and we were using that number for the foreseeable future, we knew we'd be able to give them X, $100,000 for 30 days. Let's say we know that we'd be comfortable selling $10,000 worth of stock in that month, right? That's 10%. $100,000, 10%. We can trade out $10,000 that month. Let's say we wanted to think, and in our model, we think it should take us 90 days to trade out of our position, out of our whole note. So realistically, we only want to provide as much capital that we can get out in those 90 days. And that's kind of how that was really the reason why we put this together. We put it together to really know how much can we give a company that if we were to have to trade out, we won't be hurting the stock. Like the whole idea was to be a part of the volume, not hurt the volume, not create volume. That's really what it started with and where it went, and that's why we cared so much about it. Now, what we've learned is that when you look at trading of history, one, it does not predict the future. So that's for sure. You can only do as best as you can, right? I mean, there's so many different factors. There's macro, micro factors. There's so many different factors that come about to trading, and we can go into all of these as we continue. But to touch up on this, what we learned is that there's a lot of times you really need to dig in on a day-by-day basis of the liquidity, because what I like to call outliers, right? All of a sudden, there's a press release in that one company, or an M&A transaction, or whatever it might be, or something good in the world, right? A bigger event, and they somehow are in the crypto space now, right? Right when crypto was going crazy, or they became a marijuana manufacturer when marijuana was going crazy, right? So you would have these anomalies, the outliers, these days that all of a sudden one day the thing shoots up or shoots down, but with a ton of liquidity. So we created this screener to really understand, take those out, right? You can't use those days to predict what the future would bring. So you want to remove that out of the equation to really understand what you can afford and whatnot. Like I've had so many conversations with companies, and I can't make this up if I wanted to tell them they want $200,000, right? But I tell them you can't. You realistically can't take $200,000 because of your liquidity. How am I going to get out without hurting you if you're going to take $200,000? It doesn't make sense. And I would tell them the math. I would go through the math. I would show them this is how, this is this and that, whatever. And a lot of them will say, yeah, we'll pay you back. You're not going to pay back. You're going to want me to convert out in cash, in stock. So this is what it qualifies for. And unfortunately, sometimes they get it, sometimes they don't. Um, and that's really what the screener was created for, to really
So the
understand.
idea is for a retail investor who wants to buy a position in a smaller company, right? Like not like Tesla or Apple that has billions of dollars in a daily, in a dollar amount daily volume. We're talking about smaller company, and he wants to take position. So how does he buy without pumping up the stock, and how does it sell without completely ruining? So that's why he really need to understand the liquidity factor. And what I think, Paolo, maybe you should expand on what's level 2, what's the bid and ask, and how those things works, and how they affecting the stock price when looking at liquidity.
Yeah, definitely. But before we get into that stuff that's more complicated, I think going back, simpler, why does a retail investor care about liquidity? You said it well. On the Teslas and the Apples and pretty much every blue chip stock, it really doesn't matter. They trade billions of dollars.
It does matter for a big hedge fund who's trading billions of dollars, but you're right.
Yeah, but for the smaller investor, it's
100%.
it's not relevant. But when you start to get into the smaller companies, and usually the smaller companies are the ones where the real opportunities are. Like it's not the Apple is not going to 10x, Microsoft is not going to 10x, but a smaller company might. The possibilities are there. Every big company started as a small company, so retail investors might be interested in that. But the problem with smaller companies is that they don't have a lot of liquidity. And that can impact the investor in that I can think of 3 different ways. So when you're starting to build your position, if there's no liquidity, you're going to start pumping the stock inadvertently, not because you wanted to. And that causes a problem because let's say maybe you wanted to buy shares and you could have bought shares at 10 cents. But because you started to pump the stock up, you're going to end up buying the shares at an average price, let's say 12 cents, because you pumped the stock. But you pumped it because there's no liquidity. Like if a stock trades $1,000 a day and you suddenly want to buy $10,000 in a day, it's going to matter. And it's going to hurt your position. It's going to reduce how much money you can make. On the other side of the equation, when you want to sell, like when things are going down, when you don't really believe in the company anymore, if there's no liquidity, you're going to crash the stock. And instead of, let's say that you wanted to sell at 10 cents, you're going to end up selling maybe 7 cents if there's no liquidity, which translates to a bigger loss for you. And on the other side of the equation, which might be a little bit more complicated, if you're shorting companies and you need to cover the short, you need to make sure that there are enough shares for you to cover. If there are no shares, you're going to be stuck in a very bad position. And actually, going back to what happened back in 2021, that's where short squeezes happen because there's not enough liquidity to cover a short position. So for any of you out there that's into shorting, if that's your investment thesis, it's fine, but you need to consider that because if and when the trade goes sideways, you want there to be enough liquidity for you to get out without losing more. So that's kind of the 3 avenues that I think retail investors might care about liquidity. And the way you look at liquidity, it's very different. It's a lot of different ways. So the simplest one is the one you see quoted on every single place, on Yahoo Finance, on Google Finance, on the Bloomberg terminal, on your TD Ameritrade platform. You just see the amount of shares that have been traded or the dollar volume of the shares that have been traded, and that's fine. It's useful, but there are more ways. And the way that we look at it, that way because we're more active on our approach. It's through what's called a level 2. So the level 2, what shows you basically is the book of orders. So you have 10 people that want to buy the stock at different prices, and you have 10 different people that want to sell the stock at different prices. So those prices, that book, that list of prices and orders, it's what's called the level 2. So, on the buy side, people that want to buy, it's what's called the bid. And the people that want to sell is what's called the ask. So that's where the difference comes. And,
what's the difference between level 2 to level 1?
So the level 1 only shows you the best bid and the best offer, or the best ask.
That's what most brokers gives you.
Yeah, exactly. That's the
first bid, the first ask.
Exactly. If you want more information, you have to pay. But usually everyone gives out free the level 1, which is the best bid, which is the highest price buyers are willing to pay for the stock, and the best ask, which is the lowest price sellers are willing to sell. And so that's important for you to know, because you might think that a stock has liquidity. You might see the best bid and see X amount of shares, but maybe the bid that comes next, it's 10 cents lower, which is a very big difference. Or it might be 10%, 20% less than the best bid. So it's important, and that feeds into liquidity. At the end of the day, retail traders don't usually see that information because you have to pay for it. So they only see the level 1, or they only see the volume traded, or the last sale price, or the volume in dollars, but they don't see the level 2. And the level 2 kind of gives you more information on where the prices may be, or where the prices may stop. For example, like, technical traders talk about support and resistance a lot, which is a floor or a ceiling. And when you look at the level 2, you kind of start to look at it in a different way. Like when you get to the floor, you're going to see on the level 2 a lot of orders, buy orders with different prices, but massive volume at that level. And you're going to see on the level 2 a lot of sell orders with a lot of volume. So that's kind of like the visual representation of the supports and resistance. But it ends up going back to the retail investor, because you need to make sure that there's enough for you to buy into a position or sell into a position. And it can have a lot of repercussions. On our case particularly, the difference between good liquidity and bad liquidity means making money or losing money. And that's the end of the day. At the end of the day, that's what's important for us. So if you want to sell millions of shares into a stock that trades maybe $10,000 a day, you're gonna hit the stock. You're gonna damage it. You're gonna tank it, and you're gonna lose money. Or the other way around. If you want to buy millions of shares into a stock that trades $10,000 a day, you're gonna pump it. You're gonna lose money. You're gonna lose a lot in cost of opportunity. But it's important for retail investors to know that, because when things go wrong, liquidity is fine. You can live with low liquidity when going into a stock, but it becomes very important when things go wrong. And when things go wrong and you need to sell out, get out as quick as possible, you need there to be liquidity. And that's something that you need to pay attention to. And that's why we built the tool to be able to aggregate the way that we can look into liquidity, because that's not something that most information providers give out for free. For example, Yahoo Finance doesn't give that for free. I mean, it gives you the day's volume, and it can give you can look into it, but if you want to download it, see what's going on, you can't. And some other information providers, they just don't give it out unless you pay for their $30 a month or even more for their subscriptions. So we needed a way to aggregate that into a tool to make it easier for us to see and easier for everybody else to see. And that's kind of why we built it and why it's important for us to have it. And that's why we think retail investors also need to have that information.
the way that we track it with this volume screener is big, because not only is it giving you the total dollar value or total shares that traded or the average or the price to it or anything, it shows you the history of how it got there, right? So it's a big difference when a stock's at $1 trading 10,000 shares, or when a stock's at a penny trading 10 million shares. And how so all those metrics, because you can say, oh wow, this month it traded huge, but where's the stock price if you're an investor, right? Did it trade huge at a 50% discount to where you're an investor? So, those metrics are really they're important for the retail investor. They really are. And that's what the product actually shows you. It gives you that guidance. It tracks everything for that, which is great. We couldn't find it anywhere else. That's why we put it together.
And you could also argue that, being able to look at different time periods and see how volume behaves, like not only today or a week from now, but going back to months or years before, it kind of gives you a different perspective on what happened to the stock. Like,
Correct.
was it an over the counter stock that went up to the Nasdaq? Of course, when it goes up to the Nasdaq, you're going to see a big increase in volume. Or the other way around, if it's a Nasdaq that gets downgraded to the OTC, you're going to see a drop in volume. Or if there's, back when crypto was hot, like you said, some of these companies, the volume just skyrocketed
It'd
out
be
of
cool.
nowhere.
It'd be cool to do a little practice thing, even like just around earnings releases. Hey, how does a stock trade, after a Q comes out, right? And compare it quarter over quarter, year over year, and see what the volume's like in March every year compared to the months leading up to and after. And that can give you, an interesting model as an investor of when you want to get in, when you want to get out, when the liquidity might be there, how much liquidity is there for you. I mean, it comes into the whole planning on that front as an investor. So that could be an interesting, it could be an interesting little game we could put together on that.
Yeah, definitely. I mean,
Like that.
I think this tool allows investors to, plan their buying or selling into liquidity events that, they can look
And
in
how much to buy and how much to buy, basically, how much to buy or how much to short or how much to, whatever trade you want to take, you really need to understand the liquidity on this. And the fact that we are eliminating the crazy day, the out of the ordinary days from the equation, it makes them to really understand, because if those days will not exist in the future, like Elon said at the beginning, the history, it's not always the future, right? It's almost never the future. So you want to be as conservative as possible and to understand the liquidity as conservatively as possible in order to protect yourself and know the size of the position you're able to take.
You can use the tool to compare, a comparable analysis between companies too, right? If you like a certain industry and you have 5 companies that are in that, wellness, let's say, and there's 5 companies you want to get involved with, or supplement companies that are trading right now, and there's 5 of them, and you don't know who's the best one for you to get into because you're worried about getting stuck in the stock or not stuck in the stock. You can compare them all, see who trades the most, see who doesn't have so much price, fluctuations. I mean, there's so many things that you can put together over here, using this to kind of guide you on, where you want to look at and where do you want to get involved. At the end of the day, minimizing risk, right?
Yeah.
So that's that's the name of the game, right? The name of the game is to make money, but doing it by minimizing risk. And these are the tools to use to help you, through that process.
And we are going back to the basics and teaching the basics in order to understand how to make money.
Correct. And one day, this platform is going to show you all of a sudden, for that one day that the stock did go up 100%, and it's in the, in the screener, there'll be a little emoji there or a little something that will guide you to why it happened, right? It might show you, hey, it happened because they just bought or they just got into an agreement with a big 500 a Fortune 500 company, or an AI related company or something, and that's why you ran that one day. and it only makes you smarter.
100%. So going back to the reasons why liquidity can change drastically, or why will a stock or a company will have a out of the ordinary days?
So I think usually when companies have increased volume is because there are some important or material events going on, for the good and the bad.
And sometimes it can be with the company, and sometimes it can be just the general market.
Yeah, exactly. For example, when all of these AI things started to ramp up, you started to see, of course, Nvidia was like the flagship of it, but a lot of smaller companies related to semiconductors and AI, they started to run as well. So it's like a macro event that's feeding into other companies. Or for example, like when, as Alon mentioned, when there's an earnings release or an investor day, usually you see different activity, price fluctuations, and of course volume, higher volume. Or the biggest example of all, when there's market panic, volume usually comes in because everyone starts selling. So you have the good events, which are those macro events, or maybe an acquisition, maybe the company's acquiring another one or is being acquired by another company, and you see an increase in volume. Or, for example, a biotech company might have FDA approval on their, big pharma thing that they're developing, and you're going to see higher volume. Or on the downside, when a company, I remember distinctly when that happened. I was looking at a company, and they filed for bankruptcy. A small company filed for bankruptcy, and you saw volume increase like crazy. Like it went from trading a couple of million shares a day to trading almost 100 million shares in a day because it filed for bankruptcy. So there can be negative events as well that alter liquidity, good or bad, whatever it is that changes liquidity, you need to be aware of it. So whether it is for the good or for the bad, it's going to show on the liquidity. You're going to notice, if you look historically into stocks, you're going to see that there are some days where the liquidity goes crazy. And it's sometimes because something good happened. They got an approval, they got into a merger, or their industry just, I don't know, started to flourish based on macro events. Or the other side, they went bankrupt, they lost a deal, they lost money, the CEO was fired, they caught everything, they caught fraud, accounting fraud, whatever you can call it. There's going to be an increase in liquidity. That's kind of the reasons why it might change.
Completely agree.
Those are pretty much the obvious, the obvious reasons, right? Like the reasons why retail investors would appreciate, understanding why liquidity is going up or going down. Just as Paolo mentioned, you have your macro reasons, you have your micro reasons. If it's a good quarter for that company or a bad quarter for them, or if it's all of a sudden marijuana became legal, right? Imagine what would happen, to a lot of these companies that are whatnot. So that's just affected because it could be a political issue, it could be a war, it could be a approved FDA, or it could be a failed clinical trial, right? So these are all reasons on that front. The not so talked about, I guess, that I want to more venture in at some point and learn and understand and create some kind of metrics around is news release events, and who's behind them, and how are they getting out to the market. Because I think that's also a big piece that how does it get distributed, right? Whether it's a PR newswire, or does it catch on Yahoo Finance, or is it on Twitter, or is it on the company's website? There are the other social media sites. Is it from a certain group, right? Who are the investor relations, who are the public relation companies, and how do what kind of correlation is there to liquidity and share prices, and whether it's up or down, right? So that's something that I think we need to venture into at some point and figure out, because the data's there, it's all public. I think there's a lot of value in being first to know what's going on. Like Paolo mentioned, a bankruptcy, right? The guy that's following them on a Pacer public record court document account is the first one that's going to know, right? Or the guy that's sitting at the court hearing, or whatever it is, right? So knowing that news and getting that news quick is key. Same with being alerted when some of these news releases from depending on from what sources they come out as well. So I think that's another key. A leading indicator, right? One thing I don't know if we touched on, what we could touch on at some point as well too, is market makers, right? And you mentioned level 2. Who are the players, right? Who are these market makers, and what's the difference between Knight and Paulson, or OTCN, or
Citadel.
exactly. Or
So maybe you can give
GTSM,
us, maybe
right?
you can give like shortly what are market makers and how are they playing a massive role in the liquidity, in the volume.
Yeah, I'll let Paulo take this one.
So
Since
market
Paulo is the
makers.
trader of Quick Capital and he probably understands the level 2.
I can only yell so much. He has to call them and ask. He's the one that has to talk to them and understand why the hell that bid's not there anymore. Yeah.
So
Or how is it that we gave them an order and it's gone?
and yeah, and they didn't execute.
Exactly.
Yeah, so you can put it pretty simply. Your market makers, what they are liquidity providers. When you look into a level 2, right? You go back into the bid and the ask. The ask side, the sellers, if you think of it, are offering liquidity, and the buyers are taking liquidity. So what the market makers do, the market makers are both on the side on the bid and on the offer or the ask. They are always on both sides of the equation. What they make the difference. So, they may be there on the bid at 10 cents and they're on the ask at 12 cents. And when they sell at 12 and someone buys at 10, they make the difference. That's how they make their money. But what they do is they provide liquidity. That's why when companies go public, one of the requirements from the exchanges is to have market makers. I think the Nasdaq requires at least 4 registered market makers, because that's what they do. They buy, they sell, they offer, they buy, and they create liquidity.
So how can they not lose money?
So
if they're on the sell and on the buy and somebody sell them, but now they don't have anyone to buy, how does that work?
they usually don't lose money because market makers operate in stocks that are liquid, like we said. So there's always someone selling and there's always someone buying, and it doesn't have to be a lot. Like the margins that market makers do it's minimal. It's like a penny or less. Know what they make, but they make it on volume. Like they sell millions and millions of shares, so that's how they make their money. Where the market makers may lose money is when they start to get involved into companies that are not very liquid. So they're gonna, market makers usually don't hold inventory, so they don't have any shares to sell. So when someone buys from them on the offer, they're short the stock. It's kind of like, it's hard to put into images, but they short the stock. But if there's no liquidity, no one's gonna buy the stock on the other side. So they're gonna be stuck with an open short, and that costs them money. Eventually, someone's gonna cover their short, but in the meantime, they have to pay overnight fees. They have to pay to the clearinghouse. They have to pay a lot of stuff. Or if the market maker gets stuck in a company that goes bankrupt, they have shares that they cannot sell, unload. So that's how market makers make their money. It's usually, most of the market makers, the traders for the market makers, they study the stocks, they study the behavior, they know how they move. So, and they know when big players come in, like they can tell. So they know how to play around that to make some more money, to make the spread bigger, to make more money. So that's how they play around. But the main role in the market is for them to provide liquidity, to make sure that there's always someone buying and there's always someone selling. So, you have liquidity on both sides. And you can see it's very easy to see on stocks that don't have market makers that the level two looks funky and it doesn't work and it doesn't have liquidity.
And
You
usually,
can see.
if there's no liquidity, there's a big spread, right?
Yeah, the spread is huge. It can be, 5 cents, 10 cents, so the spread the difference. And
And the spread is basically the difference between the bid to the ask.
the best bid and the best ask.
Correct. Just want to make it clear.
And that's actually, now that you mention it, that's actually a good indicator for liquidity. Stocks that have good liquidity usually have tight spreads. Stocks that don't have liquidity have wider spreads. That's kind of rule of thumb. So if you see a stock that has a very wide spread, you can tell that there's no liquidity. And now that was a very good question because it can tie back to what we're talking about the market makers. At the end of the day, the market makers take the risk of buying and take the risk of selling. So if there's no liquidity, means there's more risk. So they need to have a wider spread for them to make more money. So the spread kind of indicates the risk of the market maker, and the risk of the market maker is that there's no liquidity.
This
So
is
on
good.
stocks that are very liquid, the spread is very tiny. On Apple, on a blue chip stock, the spread is almost there. It's nothing. But on a stock, OTC stock that doesn't have liquidity, the spreads are huge.
Yeah,
Because
so if somebody is doing a market price order on a small stock, he's gonna end up like buying because the spread is so big. It's gonna end up taking like bigger bids, and it's gonna pump up the stock. Where the same thing, if he's gonna sell on a market price, it's just gonna take all the offers on like a very very low pricing, and it's gonna dump the price really quickly.
Yeah. And for the markets to get compensated for the risk, they need to have a bigger spread. And that's kind of usually how you can tell. Let's say that you didn't have access to the tool, you didn't have access to a liquidity scanner. If you look at the level one, the best bid and the best offer, if they are very wide, there's a lot of risk. And so the market makers don't want to bear that risk. They want to make good money on it. So the spreads are wider.
Makes
But
sense.
that's but the spread is kind of a complicated indicator. It can change with a lot of situations. It can change on a liquid stock, very liquid stock. On bad news, the spreads can widen. So it's not as reliable as just outright looking at the liquidity. There are a lot of things that can alter the spreads.
Fair enough. Elon, anything else on your end?
No, I think this is good as it relates to liquidity. I think we covered, pretty, the software, the liquidity tracker itself, it does exactly what we say it's, what we're telling you it's doing, right? It's providing you information on how the stock is trading, meaning the dollar amount that it's trading, the number of shares, so the quantity of shares that it's trading. It gives you the opportunity to put in certain ranges, certain time frames. You want to understand how it traded in the month of December because of retail sales, because of the holidays, and you can use it to do that. You want to understand why there's so much liquidity on April 1st, and you could plug it in and you can see the correlation if there's any release or anything like that as it relates to what happened. You want to look at how much money you want to invest and over how long you want to invest, right? You want to plan on, how are you going to get out at the same time too, right? So it gives you the capabilities to really understand the aggregate dollar amount, the aggregate share amount that's traded during that, kind of period range. And it's an amazing tool that it guides us to really understand, how we want to get involved with and how much we want to get involved with and if we want to get involved with, right? I mean, it could be amazing, but without liquidity, then what am I doing, right?
Yeah.
without liquidity is like investing in a private company.
Correct. Go ahead. Do venture capital, do private equity. Those are great too, but that's not what that's not what we're meant to do. Sometimes we're in those as well, but we care about liquidity. We want to make sure that we want to get out, that we can get out. And again, it doesn't mean get out at a profit. It just means I want to be able to get out, right? I mean, if you're stuck, then you're stuck. There's no even way out, right? And as I mentioned earlier, these tools are created to make you smarter, to understand what you're getting involved with, to see potential red flags, and to minimize the risk.
And teaching you the basics. Like we don't need like complex indicators in order to kind of like figure out where the stock is going and where the company is going to. So yeah.
The more you look at it, you see that it's repetitive. And you start understanding it more and more and more. And when you have this in front of you all the time, you realize, really what's going on.
Completely agree. Awesome, guys. I think this was good.
It's great.
We're going to see you guys tomorrow.
I enjoyed it. Thank you, guys.
Thanks, guys.